All right. So I'm going to do the final exam prep. I want to do it a bit early so that you all have a chance to study before, finals actually start and the rest of that. Um, Especially since you've got holidays and stuff in there. So we'll go through each section of the test. It'll be the same sort of format, all done on Blackboard, 70 some questions, and so we'll go ahead and get started. So as I said, the test will cover chapters 10 through 19 in the book. You'll get 90 minutes to take it, and there'll be 72 questions. So we'll try and focus it, on material that's kind of important in terms of personal finance knowledge. So there's a whole lot of stuff in the book and some of the, personal lifestyle kind of stuff. I'm not necessarily going to get involved in that, but I do want you to be able to understand all the different terms, so if somebody's referencing something that can understand what they're talking about and know kind of how to steer your money and how to prepare for retirement and save for other things. So anyway, jumping right in, there will be a question that will ask about greatest growth potential, and if you're given choices like bank accounts, stocks, bonds, government bonds, options, the greatest growth potential in those, I hate to say it, but we keep coming back to the stock market. So that can be through mutual funds or whatever. You don't necessarily have to own common stocks directly, but equities and all those terms are kind of synonymous. Equities and stocks are the same thing, and mutual funds typically are made up of common stocks. So anyway, bank accounts typically aren't going to give you the interest rate that you would consider for long-term investment. Bonds, like we said, right now with interest rates being low and even in the long term, they're not a huge wealth generator. Government bonds are safe, but too conservative and for most purposes. And then options are more of a speculative investment. We could talk more about options at another time, but it's not something you would typically put your retirement in. Other questions will be talking about bonds. Again, some of the definitions related to bonds. If somebody has a convertible bond, what does that mean? And as you know, it's convertible means it's you can convert it from stock to bonds. So you got mortgage, indentures, different things, but the term convertible itself is relates to the feature that's not available on all bonds, where it can be converted into stock. Remember, a bond is sort of like a loan from a big corporation, and stock actually represents an ownership interest. You actually own part of that company. Now, another feature of bonds that's not such a good deal for you, but is pretty much a typical inclusion in bonds, is a call feature. So if a company, let's say interest rates are high and they're having to offer attractive interest rates to get people to buy the bonds, say it's an 8% bond. Well, if interest rates drop back down, that corporation certainly doesn't want to keep paying that interest rate, and if they've got a call feature, they don't. They just call it back. They call that bond in. They give you your money back. Say you put down $20,000 and we're expecting to get a series of returns for till that bond matured. They don't have to do that if there's a call feature. So just be aware of that. There's if interest rates stay low. Anyway, the call feature is to their benefit, not necessarily yours. Remember what we talked about with stock splits? What do stock splits do? They don't necessarily generate any, well, they don't generate any wealth. They just split the stock price. So if the stock of a company was, $100 a share, and they split it, they split it, say, to 50, that means you would have two shares for those one shares. But, 2 times 50 is still 100. Now, again, like I said before, it recognizes kind of a momentum. The company's probably doing well if their stock price is appreciating, but the split itself, that does nothing. Sometimes when you're involved in investment schemes or investment, vehicles, especially in real estate. You'll get involved in a limited um, partnership or limited financial exposure, and what that means is if you invest, and again, these are legal terms, and so you would, in something that's complex like this, you would probably want to get lawyer's advice before you jumped in. But the main purpose of limited exposure would be if you invested $20,000 and the investment went horribly wrong. The worst you could be is out $20,000. If you had full unlimited liability, you could lose your $20,000 plus another 20 or whatever if that investment goes bad. So the deal is if you're in a limited exposure situation, it means you can't be actively managing it, and so you need to stay on the sidelines if that's your exposure. There will be a general manager who's involved who does have that full exposure, but you want to make sure you don't cross the streams and expose yourself to huger losses. Back when we're talking about insurance, remember we had risk and perils and hazards. Anyway, the perils are things like fire, theft, hurricane, stuff like that. That's the cause of the loss. So hazards are things you do, like whatever, leave yard equipment out there in the yard for people to trip over, big pits and whatever, faulty wiring that you know about. That kind of stuff is a hazard. So, and that also would in those cases would also demonstrate some negligence. So anyway, peril is the possible cause of a loss. Again, back to the definition of bonds. Again, they are, what are they? They're debt capital. It's a corporation wants to raise money. They don't want to sell stock in this case. Let's just say they just, prefer not to dilute the company because it's actually ownership that they're selling to that company. They don't want to go to the bank for a loan, so they go to people, and actually they go to an intermediary bank who offers bonds to individuals, or it could also be institutions. But anyway, outside investors, and in the form of a loan, and then that loan is paid back. Say you take a bond for $20,000. At the end of the term, if it's a 20-year bond, they will give you that $20,000 back. So you get your money back, although the time value money kind of ate away at it. But in that intervening years, they will also pay you interest on it. And so that's how bonds work. Again, you don't have to take it to maturity. You can sell it off in a secondary market. But the value in the secondary market is going to be determined by the prevailing interest rates and whether your investment looks attractive or not. So other things. So during the test, you're also going to want to make sure you got a calculator handy in some form. Again, Blackboard's kind of flaky. If you open multiple windows in a computer, or it looks like you're going to Google or whatever, the thing will just shut down on you. So I would recommend maybe having a second calculator or something, because there will be a question or two, like on a stock purchase. You buy stock for such and such price. It goes up in value. How much money do you make? And minus the commission. So nothing too difficult, but again, you won't want to do it in your head. When you're in an automobile accident, this goes back to the insurance business. What do you do in terms of legally, things that could kind of haunt you later? It's best not to talk about who's at fault. It's usually pretty obvious, but you don't need to make matters worse. So basically, don't discuss things in terms of liability and other things that you may regret later on in kind of the heat of the moment. Obviously you kind of make things safe and leave those discussions till later. When you're responsible for another person's loss, that relates to liability. So again, in terms of insurance sort of terms, risk, peril, liability, and negligence. Negligence is a bad thing. Obviously, that's you being drunk, you being stupid and causing problems. Liability, though, just means you, you are liable for another person's, um, if there's an accident and you're at fault and you're found liable. So doesn't necessarily mean involved in necessarily bad behavior, but somebody's at fault, and in this case, it would be you. Um, Mutual fund companies that pay a dividend, those are known as income fund, and stocks in general are known as equity, so that'd be an equity income fund. But anyway, if, I've kind of not bad mouth, but not really been that excited about income funds, because income funds, they pay income from their dividends, and dividends are kind of a characteristic of larger companies that are pretty well established. And by their nature, aggressive growth type companies, they aren't paying dividends. They're reinvesting. They're making that company bigger. So different classes of funds. Remember, we also talked about international versus global. What's the difference? So global can invest anywhere. International can just um, invest anywhere, but it's got to be outside of the U.S. in this case. So slight differences. Anytime you go to invest in a mutual fund, and you probably saw this in the research on that homework assignment, they want to send you a thing called a prospectus. Normally, you've got to get it in written form, but I guess you could probably do the accept or whatever type thing online. But anyway, it's basically legally they are required to make sure you sort of know what you're getting in on in terms of how that fund operates, what the expenses are. All those type things are pretty important, and it's worth your time to read that document. Possible losses due to negligence resulting in bodily harm. Yeah, that is a liability risk. So you have other risks, speculative. That's more of an insurance or an investment type thing, but not necessarily a solid investment. Property, personal, commercial. Anyway, liability are those types of risks that you cause. If it gets into negligence, then we're talking a whole nother class, and that's where it can get very expensive for you. As terms of comparison on investments, between any type of bond or corporate bonds or treasury bills. Again, remember, government securities are safe, but they're generally not going to keep up with inflation, or they're just going to match inflation. Bonds, again, they don't have that track record of growth. But stocks, they do have a 10% overall type yield characteristic. That's, again, you don't do these things for the short term, because the stock market will go up and down and all over. But if you look at the long term, and that's how you should be investing, 10% is not a bad rule of thumb. We talked about the different class of mutual funds. So, growth ones are the ones that are going to be hopefully outperforming the other investments. And like I say, income is usually income funds, even though they're paying a dividend, the appreciation that the capital gains you'll get from the growth of that stock is typically not the same. There's always exceptions, but for the most part, that's correct. If you are, say, you get somebody to vote for you, you're going to get somebody to vote in terms of a stock representation or something like that. What happens is, as I said, when you buy stock, you're actually buying part of a company. So it's going to generate a bit of mail for you. Not much, but once in a while you're going to get a thing in the mail called a proxy, and you will have the opportunity to vote within that corporation. But the strength of your vote, it's not a one-for-one type thing. The representation in terms of your voting power is based on the number of shares you own. So if you've got like a whopping 30 shares and somebody else has got 100,000, so anyway, usually not worth the postage to mail the thing back to them. But there's a legal requirement that they mail it to you. So depends what you're interested in. Also, different types of funds. Mutual funds. There's at one point there were actually more mutual funds than there were companies. So more mutual funds than corporations. But they do have a type of fund called a life cycle fund. Life cycle funds would invest in different stocks at different periods based upon a target date that they would set for your retirement. But I'm not a big fan because most of the time, not everybody's that typical, and not everybody's retiring at the same time, nor are they, people tend to work and are still generating income when they're retirement age. So just, it's you may have came across them on the mutual fund sites, but not a huge factor. You also have, regional funds, sector funds, equity income funds. We've talked about equity income funds already. Regional funds would be stocks that are going to invest in, like, well, it could be investing in Alaska, or they could be investing in the southwest of the U.S. Or sectors could be pharmaceuticals or timber or organic products or whatever. I mean, there's so many different sectors, and it's however they want to split them up. And then a family of funds is just typically what a company offers. Fidelity, Vanguard, somebody like that will have a family of funds, and those are all the funds within their company. So, other things to deal with investments, people often will say that real estate, and it's true, that they're illiquid. The thing about real estate is, and especially as a salesperson up here, there are a multitude of ways for either the buyer or seller to get out of the contract. And it takes a while. First, you've got to market the property, then you've got to go through the whole process, the closing process, and we're talking a minimum 4 to 6 weeks, depending on the complexity of the property. And at any point within that property, the deal can fall apart. So, if you're looking for quick money to pay some bills, and you need an emergency fund, you would not want to have that in a real estate investment. So, what can you do with your life insurance proceeds? So jumping back to life insurance, why do people have life insurance? Yeah, so obviously to pay off a mortgage would be good. So the folks that are dependent upon you no longer have to deal with that. If you estate taxes is also good, so you don't leave people with debts, or if you do give them money or something like that, or property, they aren't forced to sell that property to pay the taxes. And then if you're pretty well off, you can also do things like endowments and charitable type requests and stuff like that. But the main thing is just to kind of clean up any mess before you leave, or not necessitate the sale of an asset. If you give somebody a huge chunk of property in some sort of inheritance, that person might have to sell the property to pay the taxes to keep that property. So anyway, got to think that stuff through. When you go to a doctor's office or something, and you've got to pay a certain amount before you're seen, in low level type stuff, a lot of times that's called a copay. But in bigger things, and in like car insurance, for example, it's typically a deductible. You'll have a deductible based upon, you have to pay the first $500. So if there's an accident and there's, $4,000 worth of damage, and you've got a $500 deductible, you would pay the $500, and then the insurance company would pay the other $3,000. So, regarding retirement, as you saw from those charts, the big deal is that you got to start early. Even if it seems like a small amount, it establishes a habit, but also the power. If you put down $5,000 this year as opposed to $5,000, 20 years from now, it's a huge difference. So again, consult those graphs that I've sent out and we've looked at, and it will emphasize the fact. The other things about retirement that people don't understand: Medicare is not going to pay for everything. Employer pensions are kind of a thing of the past, and when they do exist, a lot of times they may not cover everything. and people are living a lot longer in terms of retirements. So, if you do have a contract out there, a policy, and it modifies, if you have like an addendum to that contract, something that changes it a bit, that would be a contract rider. So, let's say you've got a lot of personal jewelry or guns or something like that, you would want to make sure that there's a something spelled out, an addendum, a rider to that contract that lists those items individually. Because if you try to just claim those under a general policy, you'll find that things like jewelry were limited to maybe $1,000, $2,000, or something, whatever it is in the general policy. So just because you own it doesn't mean it's insured if it's something that exceeds the standard contract. The other thing about getting back to mutual funds, the number of people who own them, I mean, it's huge. I guess 87 million is the number they're using. Most of the households, over half. So anyway, the amount of money controlled through mutual funds is most of you, I would venture to guess, actually are starting to get some mutual funds either through your family or through employee program. When you own a 401k, in most cases, that's some sort of mutual fund. They're invested in stock investments. So when you're buying stocks, if you want to buy individual stocks, if you're trying to place an order, you can do it one of a number of ways. I mean, I'm not talking which brokerage you're going to go through, but any of the brokerages, when you place an order and you say I want to buy 30 shares of whatever stock, you need to tell them whether you want to buy it at the price it is right now, which is the market price, or you can also say I want to buy it when it descends to like $30. That would be a limit order. A stop order would typically be used on a sale, and only when you're making money. So let's say that you bought it for 30, it goes up to 35, and so you're feeling pretty good. You're thinking it's going to go higher. You don't want to sell it right now, so you put in a stop order for say $31. So worst case, if that stock price drops, well, when it gets to $31, all your shares are sold, and you at least ended up with $1 per share profit. But hopefully that's not going to happen. Hopefully it's going to go up to 40, and then you're going to move your stop up, and you're going to do all this complex stuff. But anyway, market limit and stop orders are things you should know. Insurance, back to like auto insurance, people that have problems in terms of let's say they still have their license, but they've had a DUI or something like that. Insurance companies aren't going to want to touch you, but they need to. I mean, if you're still have a license, you're still planning on driving, you still need insurance. So what they'll do in the state is they'll put them in an assigned risk pool, and say there's whatever number of folks in there. Each insurance company that does business in the state has to take a portion of those folks, and anyway, they can charge you pretty high rates because you're a high risk. So SR22 are those type of things up here in Alaska, and every state will have something like that. When we're talking financial leverage, what are we talking? It's using borrowed funds for investments. So it can be typical and very powerful, like in real estate, for example. You just about always use borrowed funds for investing, but that's because real estate's pretty solid, and obviously it's not going out of business. It's not doing things like that. If you're leveraging the stock market, you could do incredibly well, but you could also get yourself just wiped out. So anyway, brokerage is, if you wanted to use borrowed money to buy stocks, you're going to have to do a lot of extra paperwork, and you're going to have to show the financial means to cover your losses, because you can get stuck. In fact, there can just be normal fluctuations in the stock price, and they'll do what they call a margin call, and anyway, you can get stopped out of the market inadvertently, and it's just not a good thing. Most people will not buy stocks on with borrowed money. In fact, that again, that's one of those things that goes beyond personal finance because that's not really a prudent way of doing it. That's more of a speculative investment. So, Standard and Poor's. So Standard and Poor's does a lot of things, but a lot of it has to do with rating bonds, and so they have different classes. You know, you have A-rated bonds, double A, triple A kind of stuff. When you get down into D, well, D is easy to remember because D stands for default. So that company is basically they're not paying at this point. That company is going out of business. So you don't want to buy junk bonds like that. So again, it's a little easier to figure out when you call it a junk bond. And like I said, AAA, and again, it makes a difference whether it's capital A's, little A's, whatever. AAA, capital A's is the highest bond rating. We talked about when you get equipment or whatever that's a little bit more expensive than normal, and you have to have an extra policy for it. Typically, they call that a personal property floater. So, again, if you had guns or equipment or whatever, camera stuff that's really pricey, you would want to have that delineated specifically in an insurance policy, and the policy would probably be fairly reasonable, but again, you have to make sure what it's going to cover. Theft, damage, other things. You want to make sure what you're indeed covered for. On insurance, and in terms of property insurance, so we talked about perils. We mentioned risk, deductible. We already talked about, but a hazard, and a hazard is something that is a known problem. A coffee maker that shorts out, that would certainly be a hazard. Any kind of known problem would be a hazard. We talked about liquidity when it comes to investments, the ability to sell things. So stocks are quite liquid. Obviously, government bonds, bank accounts, obviously incredibly liquid. But a lot of times with investments, even when they're cash investments, let's say they're certificates of deposit, you have a time limit associated with them, where if you withdraw before, let's say 2 years, 10 years, whatever it is specified, you agreed to that to get the higher interest rate. But if you take that money out early, you pay a penalty. So it's liquid, but with a penalty. So when we talk about personal investing and you saving up, the concept is paying yourself first. If you go on this plan where you're going to get the money at the end of the month, and that's what's going to be used for investments, it's going to be inconsistent, and it's probably just not going to work for you. The best way to do it is to set up with some sort of company and have a debit or a bill basically set up for yourself to take care of your investments. And it doesn't have to be a huge amount, and you can still go with the other method of money that's left over at the end of the year or end of the month or whatever, investing that as well. But what you want to do is you want to make sure that you at least get your minimum investment goals covered by paying yourself first. So if you do, again, I'll talk about stocks, I'll talk about real estate, and people will decide, that's just too risky. I want to just save my money. I want to put in a very conservative investment. But the problem with that is inflation will eat that up. The $100 or whatever you save will still be $100, but the buying power of that $100 will will be eroded by inflation. So um, that's what that concept has to do. When you're doing life insurance and you have a beneficiary, so that would be the person that you name to to get the proceeds of that. So if you have $100,000 life insurance policy, that person would get that $100,000. Trustee, those are people who act for you to settle estates. Guardians obviously can take care of children, things like that. Um, anyway, but the beneficiary is the person who's gonna get the money. If you're looking at, again, investments and you're trying to get the largest return possible, it's not going to be um, T-bills or even certain stocks. Anything, the yield of a stock, potentially, or the yield of a bond is directly related to risk. Um, if you're involved in a stock that you get a stock tip from somebody and this company's going to double in whatever number of days, that's speculative. You're betting on events, and it's almost a form of gambling. But it's better than gambling because somebody's going to win in this case. If you pay more for the stock, that the next person's going to do well. So there's not necessarily a casino there making money. There's going to be some folks making some commissions, but anyway, those are known as speculative stocks because they are pretty risky. When we talk about insurance and we talk about annuities, remember annuities are kind of just like the opposite of insurance because they pay you the longer you live. So if you put down, say, a chunk of money, again, something like $20,000, you buy an annuity. That thing, it can be a deferred annuity. It can start paying at a future date or it can start paying right then, immediate. But anyway, depending on the amount of money you want to get back and when you want this income stream to start, you'll select the annuity you want. But anyway, since you've put that money down, that $20,000, that annuity is going to start paying, and it's going to start paying, let's say, $100 a month from then on for as long as you live. So if you only live till next week, that was not a good deal. But if you live to be 100, annuity can be quite valuable. So again, it's if you're optimistic, if you're in good health, and if you need that type of investment, annuity is something that may be definitely attractive to you. When somebody passes away and they don't have insurance, that's called intestate. Okay. If that happens, then the state is going to have to sort this thing out. So when you do that, there's going to be delays. There's going to be lawyers trying to guess what you wanted to do, and nobody's going to be in good shape over this. The people who would be the beneficiaries, because the state will likely split it up in a fair manner, but not the manner that you specified, because, well, you died intestate. You didn't specify a manner. And so, the legal cost and the delays and everything else, it's just not a good way to have things happen. So get a will, like I say. Go to a lawyer, get a worksheet, work with a paralegal, and, it's kind of one notch down from a lawyer, but much cheaper per hour. You get that thing kind of finalized, and then you bring in the lawyer at the last minute and get the thing witnessed, and you're good to go. But that's typically the best way to do it. You don't want any of these funky, sort of non-will, just sort of written statements. They need to be witnessed. They need to be, you're trying to satisfy the burden of the court to keep this thing out of court, and so you want it simple. And then you go back and you reevaluate it. When you have a major life change, you get married, more kids, different property. But again, those things have to be pretty big. The marriage thing, though, is definitely a pretty big, because that's gonna change the circumstances. But you buy a new car or a new house, not a big deal unless you had some sort of funky will where you actually specified property addresses and stuff. For insurance, when you're doing term insurance, for life insurance, or it can be for property as well. But anyway, the term specifies the time period, right? So when you buy a term life insurance period, there's going to be a certain number of years associated with it, and a premium amount that you're going to pay. But the good thing about that is it kind of forces you to update this. And like I say, life insurance needs should decrease over time. The time when you have the highest need for insurance, it kind of peaks when your children are young, when your house is very nowhere near being paid off. But when you get older, number one, you become more expensive to insure because the odds of you checking out are much higher. But if your house is paid off, your kids are through school, your requirements for insurance are much less. And if you did things right in life, you should have a huge nest egg, or a big enough nest egg to cover whatever costs you had. So skip the insurance. Don't buy life insurance, and you never buy life insurance for a baby. That's just silly. You buy life insurance for the parents. If the kid happens to pass away, that's a horrible thing, but it's not, you didn't win the lottery. That's just creepy. What you need to do, though, is if you die, and that child needs money to get through its life a little bit, and so don't take out insurance on the child, take out insurance on the parent. But anyway, enough of that. Mutual fund, we talked about why mutual funds are done. They don't invest in a single stock. You're diversifying. Like any stock investment, when you hear of guarantees and the federal government making you whole in case the bank defaults or something like that, not going to happen. You're buying stocks. There's more risk. So FDIC is not part of it, and the rest of that. When we did talk about stocks, we talked about beta. High beta stock would be a volatile stock. Low beta stock would be a pretty sluggish kind of solid sort of stock. Most people, depends on what you like. I tend to prefer high beta stocks, but anyway, beta's got to be defined as something, and so that number is going to be for the S&P, on which beta is based, is 1. Okay, so if something's more volatile than the S&P, then it's say a 1.2 or a 2.0 or something like that. And if it's less volatile than the S&P, then it's maybe a 0.75 or 0.5 or whatever. So, the S&P is going to move around itself. But if it moves around at a rate greater than the S&P, then it's a high beta stock. When you're buying mutual funds, you've got loaded funds and unloaded funds, or no load funds, not unloaded. But anyway, no load is typically what you want, because a load is like a sales commission charged up front. So using that whole time value of money concept, it's not a good idea to take a commission off the front end, because that's the money that was going to work the longest for you. Plus, it's largely unnecessary. You've gone online, you've seen how easy it is to buy mutual funds, so you just do it. Closed-end funds, open-end funds, those had to do with funds where they actually have a certain investment limit. Typically, you're dealing with open-end funds, so you don't have to worry about that. Back in terms of insurance and risk and avoidance and assumption and shifting and all that. Okay, so if looking at insurance, avoiding driving altogether, that would be risk avoidance. It's also completely impractical. Risk reduction would be something like wearing seatbelts, or getting a car with safety equipment. So a little bit better. And risk assumption is when you put that risk, rather than being self-insured, you pay somebody like an insurance company to assume part of that risk. So we've talked about what happens with bonds and their value in relation to interest rates. What's going to happen is, and the reason why bonds would not be an attractive investment right now, is because interest rates are pretty much going to go up. If they're very, very low. In fact, they're even negative in certain countries like Japan and stuff, which is strange. You put money in the bank and you're losing money. So I mean, they're trying to get their economy going, so they're trying to encourage investment, trying to keep people from putting their money in the bank and just sitting on it. So anyway, but how this has to relate with bonds is that the interest rates right now paid on bonds are very low. So if you've got a bond out there and it's 2% and interest rates go up, that value of that bond, that if you want to sell that bond in the market, when bonds, let's say in the future, are being sold that are giving 3 or 5% interest rate, and you've got this pretty much a dog of a 2% bond, nobody's going to want to buy it. So if you're trading in the secondary market, let's say that bond, you bought it for $20,000, well, people are going to give you 15 now. So anyway, that's kind of the argument why you aren't buying bonds right now. If you die without a will, who takes care of it? Is it federal court, IRS? No. It's a state problem. The state courts take care of wills, probate, things like that. More things about wills. It's basically what you're feeling in terms of the disposition of your property. It's not there. You've got all these other documents that were listed in there, these letters of instructions and these ethical wills and these even prenup type stuffs. Now a will is a legal declaration of how you want things done after your death. Why do you have life insurance? So just like I said before, it's based upon needs, and that's the beauty of term life insurance. How much life insurance do you need? Well, what you do is you look at how much is my outstanding mortgage, how much are the kids going to require for college, and you're probably going to come up with a pretty high figure. And sometimes you can mitigate that figure by saying, okay, after 7 to 10 years, the spouse is going to, be working now and going to defray part of that. And anyway, but the beauty about term is you can change that term and say your house is now paid off, and you can say, okay, I don't have to worry about that, and you can get rid of that amount, or the kids decide not to go to college or whatever. Well, you don't have to worry about that. And so the goal is to not pay life insurance at the end. When you're doing estate planning, you're talking about every bit, in terms of people's basically deaths, in terms of what things are going to be done, in terms of the management of your estate. So estate planning is it deals a little bit with the management of property while you're still alive, but the bulk of it is how things are going to be settled when you pass away. If you've got a matching program with whatever company, that's pretty much a no-brainer that you're going to achieve that matching program. So if they match, like, say, 3% of your salary, you would definitely want to put in at least that 3%, because that's, to you, it's really should be valued as a increase in your income by that amount. There's no guarantees when you're buying, mutual funds that you're going to get a different rate of return if you had bought those stocks individually. You can do the same thing. You can make sort of your own mutual fund by having a variety of stocks. But the reason people do mutual funds is A, because it's easy, and B, because there's a person in there to manage those funds for you. Now, again, the track record of some of these guys is if they just would have kept their hands off the stocks, they would have done better. And that's where certain folks come up with what they call index funds, and that works out for them too. Um, if you're investing in stocks, again, this is the time to have a calculator out. You can basically, if you're given a problem that says how much money did you make over time, you would look at how much money you actually invested, kind of like these graphs, and you can look at how much of the money was mine, and how much was made on interest or capital gains, and then you subtract out the commissions if any of that was paid, and that will give you your true yield. All right, we're kind of jumping all over the place, going back and forth between insurance and investments and stuff like that. But back to life insurance, So who needs life insurance? I mean, should you feel guilty that you don't have life insurance right now? Well, if you're somebody without kids, living alone, absolutely not. Even dual income, no kids, unless you got yourself into a house that takes two incomes to pay for, and then maybe you might want to consider some insurance on that. But really, it's the people that have small kids with a new mortgage, and especially if you've got a stay-at-home spouse. Yeah, you represent the breadwinner, and you need to have some sort of protection, or else you're going to devastate that family. And it's usually, especially if you're going with term insurance, it's not that big a deal. The expense of it, term insurance is not that expensive. Now, the thing is, the reason why you're not buying whole life or universal life or whatever is because they're more expensive, and they combine investments in along with that insurance. So if you're buying term life insurance, and let's say you're spending $50 and maybe getting $500,000. It's going to depend on your life circumstance. But let's say you're spending $50 a month and you're getting $500,000 worth of coverage. Well, you should, not be greedy and go buy, new stereos and snow machines and stuff with that money you're saving. You should go, cool, that extra, say, $250 that this other policy would have cost, that was going to give me some sort of investment part. I am going to get that $200 savings in this case, and put that in a real investment. Put that in some sort of mutual fund, and that would be the start of your savings plan. So the sort of windfall that you're going to get by being smart investing in term insurance, the best way to look at that is to use that savings and invest it in a true, clear cut, easy to understand, policy, not policy, but investment, whether it be some sort of, maybe a real estate, maybe some sort of income property, or maybe just mutual funds or whatever. Health policies, yeah, the biggest provider of health insurance has been companies. Now that may change over years. The whole health insurance policy, it doesn't have a sponsor, is the problem. Nobody wants the current system. And when I say that, I mean Obamacare or Affordable Care Act, because number one, the more conservative Republican side, they weren't happy with it, and the other side, Democrats and more liberal leaning folks, they would have preferred single payer, which means the government. So this sort of hybrid that we've got now is whatever. It won't last. So I wouldn't invest too much time. I mean, you've got to invest, especially if you're spending a whole lot of money. You got to do the best you can. But I don't think it's a system that will be with us. It'll go from to a different extreme here in the near future. We talked about negligence. What that means in terms of liability, and failure to take ordinary and reasonable care. So, it's one thing to slide in the snow and smack into somebody's car. You are liable for that accident that you probably caused. But if you're going 90 miles an hour and you've got ball tires and the rest of it, you're, in addition to being liable, you're up into another category of negligence. So you don't want to be there, because that's where you will get penalized. You will go to court and whatever. It's going to not be good for you. And then there's the other things, negligence. If you own a pool, sometimes you're just by definition negligent. that some kid could walk into it. If you don't have a fence, you're definitely negligent. So, again, depends on the issue. There are theories about, why would you want to invest in like precious metals and gold, and the theory is that if the world goes to whatever, that gold should go up in value, because people are going to maybe lack trust in government, and they're going to go back to things that are based on tangible assets such as gold, which is probably right. So anyway, that's the theory. It hasn't always, we don't live in necessarily settled times, and gold prices are pretty low right now. All right. So if you haven't noticed, I can pause this thing to keep the recording. I mean, this is a lot to take over. I realize it's going to be, over an hour by the time we finish. But anyway, so, that's why you've got a few weeks to look at this. And I'll have that final exam open that whole period. And if you, run into problems, you can call me and I'll reset it and stuff. And as long as it's not, somebody needing to get reset a couple times, it's not a huge issue. So, all right. In terms of stocks, we talked about, all the different classes of stocks. And then just like we talked about speculative investments, there's also the notion of penny stocks. Penny stocks are stocks that, they don't necessarily trade for a penny, but a lot of times, unfortunately, they end up at a penny, unfortunately, just before they go delisted. And I've bought them before, and we used to run this one stock. It would trade it for like 33 cents, and it would go up to 50 cents, and it just made these huge swings, and it was kind of fun. And it was kind of like Twitter. Twitter's not a penny stock by any case, but Twitter is something that the big institutional investors will typically stay away from. So it performs erratically, but at least you aren't necessarily up against the big institutional investors. But penny stocks are it's like betting on a football game or something. It is not an investment. And the problem with penny stocks is, too, that there's such a small market for them out there that people can manipulate them pretty easily. They do the pump and dump thing. They'll buy a whole bunch to drive the price up, and then they'll hype it. You'll see all these, you'll get this insider information that this is the greatest stock ever. The price goes up, and then boom. The guy who's manipulating the stock sells, the price drops, and you get clobbered. So, again, I'm not recommending whatever that movie was, Wolf of Wall Street. But if you remember from seeing that show, if you happen to see it, the only people getting wealthy were the people manipulating the stock and the salesmen with their commission. The actual investors, they get clobbered, as they should. It's a speculative investment, so don't fall in that trap. I can verify for you that you will lose a bit of money. But again, $100, $200, that's all fun. But if you're losing tens of thousands of dollars and putting your retirement in it, your life has gone horribly wrong. If you just received, some inheritance, and you decide, okay, what am I going to do with it? You don't have to put all your investments in one particular class of investments, and nor would anybody recommend that. So, ultimately, you ought to have, what they call a portfolio, where portfolio is just a general term, but a collection of things. You ought to have some real estate, maybe some cash, and even in your mutual funds, you can even diversify. You wouldn't want everything in, say, pharmaceuticals. You might want something in another class. You might want some foreign stocks. Right now, foreign markets are way down, so maybe there's opportunity for growth in the long term, but in the short run, local stocks or U.S. stocks are doing much better. But anyway, that has to do with what they call diversification, not having all your eggs in one basket. Again, we've talked about the term probate. We know what the estates are kind of what you end up with at the end of your life. That is your estate. The will is the instructions as far as how that thing is going to be transferred. A trust has to do with kind of the vehicle that's set up. You'll have a trustee, and he'll settle that account Probate is the state court that handles this, and if you're in probate court, again, you've done something wrong. What you do, your extent of being involved with probate court may be just a judge looking at the document, going, okay, yeah, everything's in order, next, and things are taken care of in concert with the will that you set up. So you don't want to be involved in probate or lawyers or any of that stuff after you pass. You want to do all that beforehand when you control it, can lessen the cost and do the rest of it. For insurance, we're jumping back into auto insurance. So you have different types of insurance. You always got to have liability insurance. You can't drive a car and be kind of a burden to society, the fact that you're going to crash into somebody and not have any insurance. So you can be self-insured, but that usually, in order to be legal, you usually have to post a bond with the government to say, I've got the funds to cover this. Then you have other kind of optional type insurance. Comprehensive is, things that, vandalism, damage, it's sitting in your garage and something collapses on it. There's kind of a fine line with sometimes, and you have to check with your policy whether, the house burns down and the car's in the garage. Is that covered? Probably not. But anyway, and then you get into what they call collision. Collision is that fixes your car. So let's say you're at fault, you go sliding into the intersection and you hit another car. Liability insurance is going to fix that other person's car. Your car is your responsibility unless you have collision on it. Now, collision, though, can get kind of expensive. So if it's an older car, you may want to skip the collision and just go kind of self-insured. I mean, I had a Dodge Viper, right? It was worth maybe 30-some grand. The insurance on it was going to be $27,000 a year for collision. So that was kind of a no-brainer. Now, I could buy a new car every year, but that's just because it was a dangerous car and dangerous. I was in Germany and it didn't have anti-lock brakes. It had way more power than it. Anyway, it was very, very expensive. So if you've got an older car and you're still carrying collision on it, you might want to think that one through. If you've got a new car, and especially if you still got a loan on it, yeah, you better have insurance, because it's quite possible to crash somebody's car. Because when I say somebody's car, you may own it, but the bank really owns it until it's paid off. And if you don't have collision on it, you may be without the car, but still with a car loan. You may be making payments on a car you no longer even have. So that's an ugly situation. So you need collision on something like that typically. If you've got a kid that throws a rock, and it's your kid, yeah, guess what? It's your liability, vicarious liability. So you can be held responsible for the actions of others. Typically, it's the situation where it's your child who does the thing. Sometimes you hear about these folks, the punk kids will go out and have a big house party and trash somebody's house. Yeah, they come back to the parents, so don't do that. Mutual fund. We had different types of funds. Again, growth, income type funds. Typically, those are two separate things. Growth funds, income funds. Income funds, lap dividends, small caps. Anyway, and then you also have sector type funds. And the sectors would be, say pharmaceuticals again, or some type of, defense or something like that. They pick some sector of the economy, healthcare, and that's what they're going to invest in. What's true about Social Security? This should be, if you've done your term project, you kind of know that Social Security may not be enough. It's not going to be that safety net. You will be the greeter at Walmart if you're relying strictly on Social Security and you still want to eat. So again, it's Social Security. Unfortunately, for most of us, is just a tax. We'll never see any of it. It'll be means tested, and anyway, just look at the equation and see what's happening to the process. We've talked about stock splits already. More questions on that. We've talked about what happens to bonds when interest rates go up. As interest rates go up, it makes bonds less attractive, or at least your bond, if you're holding a bond, less attractive. We talked about illiquidity in real estate. We've talked about stock splits over and over again. We've talked about how to do calculations for investments. If you have a certain number of shares and the price goes up, and if there's dividends in there, that would be part of the calculation. And obviously, any kind of commissions that would come out of it. So keep figuring that out. What kind of stock should you be invested in? Categorically, if you're young and you're not looking at using this money for a while, yeah, growth is where you want to be. So you've got, safer investments, but again, I'd say it's a false sense of safety if it's a government bond that's not going to, make any money. Really, it's going to lose money compared to inflation. You need to get that sort of 10% that you're trying to achieve to build that nest egg and do the other things you want to do. Growth stocks are where you should be. Renters insurance, we talked about that. Liquidity, we talked about that. How do life insurance companies, come up with establishing premiums? Like when I say term insurance is going to get more expensive as you get older, that's because they have these mortality tables. They have these actuarial guys, and that's what they do. They sit around and they calculate, your based upon your blood pressure and your smoking and all these other questions they're going to ask, and your age and your gender. Males are going to die a little bit earlier. Anyway, all those things are going to factor in, and that's going to equate to a premium. So it's pretty grisly work, but anyway, it serves a useful function. What is a statement? In any time, if inflation is very high, there's a chance that almost any investment won't keep up with inflation. So there's also, double-digit inflation. It hasn't happened recently, but it certainly can come back. So keep that in mind, that there's always sort of a risk factor that your investment will not keep pace with inflation. And if it's say some sort of municipal bond or something, even though it's tax-free, if the rate of return is down in the 1 to 2%, that's not going to keep pace with inflation. So keep that in mind. That's going to pretty much do it. Like I said, there's going to be 72 questions. I've kind of given you an overview of what's important, tried to summarize some stuff. I'll get this posted so that you can review it at your leisure, and you probably won't want to do it all at one sitting, obviously. But the test, obviously, you'll have to do it all at one sitting. Have the calculator available, and be ready for up to 90 minutes. And let me know.